A new global monetary system. I've had so many messages and inquiries asking me what is really going on behind the scenes, and do you think that there's a new global realignment that's going to be occurring and resulting in some monetary disturbances? And well, we've already got some clues to that. We're going to get into that today. Good morning to all of you. I hope that your holiday weekend is going well. This has been a very requested video. Again, I'm going to try to keep it very simple because A, I'm a simpleton and I like stuff delivered hot and simple when I get it. I don't need a lot of jargon. I had enough of that in business school back in a million years ago to last a lifetime. There's a lot of things going on right now. There's a lot of people that are very concerned that they're seeing things that they never imagined that they would see in their lifetimes, and dramatic moves in things like the gold market. What's going on? It just seems like it can't go down. It seems like it's being drawn upward as if it's by a magnet and going up. Well, there could be something underlying that. And one of the realities we want to get into today is a reset of where the wealth is going in the world. And there's no doubt that over the last 10 years in particular, there's been just rivers of gold, so to speak, rivers of currency, U.S. dollars flowing towards China. Not just from the United States. You have to understand that the global trade currency is the U.S. dollar. If you're in Zaire, or you're in Ghana, or you're in let's say Cambodia or a place like that, they don't want your Cambodian currency. They don't want your Ghanaian currency. They want U.S. dollars. Right? Because it's what they call very fungible. It's very spendable. You don't have to go and twist somebody's arm to take these Ghanaian dollars and change them into your local currency. The U.S. dollar always meets the market. So it's always been the number one trade currency. And that gives us a lot of latitude when it comes to international finance, in terms of calling the tune, because there's so many dollars out there in circulation in the world. It puts the United States in a very powerful trade position. But over the last 10 years in particular, we have seen wealth increase in other nations. To it, China, of course, runs a very strong trade surplus, a huge one with the rest of the world. And you have nations like India that have been rising rapidly in industrialization, population, and they're really starting to exert influence in the world. Then you have Brazil. Basically, the BRICS nations that we talk about. They've reached a magnitude of wealth generation and trade and economic advancement now that, taken individually, their currencies may not be strong enough to best the U.S. dollar in international trade, but it's possibly taken together as a unit, this BRICS, that it becomes a very formidable currency that competes against the euro and the U.S. dollar. All of this puts the United States in a very uncomfortable position, where not only do we have a very large budget deficit, we also have a huge trade deficit. And the problem for the United States, unless you're running a strong current account surplus, then when you put, in other words, your books are balanced, you're in the plus, you're in the black. Unless you have that, when you start tinkering through trade with tariffs and things like that, then you can potentially exacerbate, you can make worse this current account deficit. So this is far different in the 1880s, 1890s, when tariffs were put on, because we were very strongly industrial at that time. We had a huge industrial base coming out of the Civil War and going into the fruits of the Industrial Revolution were coming to pass, with more mechanical labor saving devices and huge economies of scale setting in. across the world. This was a very powerful move. We did not have current account deficits. Right? We were in a position where we had a very strong domestic market. There was a lot of money being made, and well, the plutocrats, the oligarchs, as they like to call them today, where they say, you know, boys, we got a good thing going here. And if we let these people from these hordes of Asians and other people start to undercut our markets, we're gonna be hurting. Okay, we don't want to lose our what we have. Let's not kill the goose that lays the golden egg. So up go the tariffs. Nothing like today's tariffs. These things they're unsustainable. But the point was, it worked a crushing, massive hardship on a lot of people in this nation that had to pay up more for goods. And it resulted in Grover Cleveland, who was reelected to a second non-consecutive term, just as President Trump is his second non-consecutive term, was run out of office on a rail. He was so disliked by the end of his administration, and the tariffs were defended, and then they eventually came off. Now, you say to yourself, what does this have to do with the monetary system? Well, it comes to a point where other nations, particularly trading nations in the world, have accumulated large balances of U.S. dollars through their own trade activities. Let's say somebody in the Ivory Coast sells their cocoa to Italy or to England or whatever, and the international currency is the U.S. dollar. Well, instead of changing it back to British pounds, let's just start a dollar account. Fill it up like a regular savings account. Just every dollar we get, we'll pop in there. There does come a point where there's so many dollars scattered here and there, and the originating country, the country that's producing the dollars, has finances that are so out of whack that people begin to wonder, gee, I wonder what they're going to do when they wake up that one day and realize that people are starting to sell dollars. Right? They say enough is enough. We got enough dollars out here to choke a horse. We don't need any more. Okay. They start to sell those dollars. Now, what do they do with those dollars? Remember, they're worried about they start to think way ahead, and people are paid to think way ahead. May not ever happen, but some type of credit default or credit restructuring. And it's a game of musical chairs. And they don't want to be the ones, when the music stops and the silence hits, the ones that don't get a chair. And here they are left with fistfuls of grubby dollars and no place to use them and have a depreciating currency. Well, I can tell you what some nations have done, and I think it's the BRICS nations. As these dollars have come into the United States for probably the last 10 years, they've had the idea, they can see the writing on the wall. They see the huge deficits mainly created by health and human services spending, to social securities, to disabilities, to medical care and all that. They look at that and say that's untenable. Doesn't matter if you tax the rich or whatever, it's not going to make a dent in that. You have all these government programs that continue to be funded. Hence, Elon Musk is in there with his Doge team. We cut $150 billion. Well, $150 billion is hardly, right, a week of federal deficit accumulation. The money, the debt owed is piling up that fast. So it really hasn't made a dent. I showed this chart before, but it bears showing again. You can see that the spending in the Trump administration versus the Biden administration, if anything, the spending under President Trump has accelerated. And it will continue to accelerate, of course, because interest rates are higher as new debt is rolled over. But let's get back to this dark and sinister operation that's going on as these nations of China, India are accumulating, Brazil, all these US dollars. They say to themselves, well, one thing that we've noticed here over the last 10 years is the price of precious of gold in particular has been suppressed. It's been kept artificially low because it's in the interest of the United States to keep that artificially low, that price of gold until today. You know what I mean? Back in 1930, before 1933, people could own gold. I have gold. I have a $20 gold piece. I can go into a bank. I can take that $20 gold piece. I can turn it into a $20 gold certificate. Conversely, I can take in my $20 gold certificate. How you doing? Yeah, slap and skin. I can get your $20 gold piece and walk out the door. After 1933, April of 1933, when Roosevelt called in all the gold, there was an immediate revaluation of gold to like from $20 an ounce where it had been pegged to something like $25 an ounce, which was the really first attempt at inflation to get prices to stop falling and start going up during the Great Depression. I don't want to get too technical here. But in 1971, so from 1933, 34, 35 to 1971, gold was revalued again. It's like 30, I don't know, something today. It's held on the Treasury's books at like $42 an ounce. You say to yourself, we're rich. We're rich, right? If we revalue that to today's market, wow, it's almost $1 trillion, right? Ooh, jazz hands, we're excited. By artificially keeping this price low over the years as not to induce any thoughts about financial instability, because remember, gold is the truth teller. And over time, it's like if you take a thermometer and take it off the wall, maybe it's 100 degrees outside. You take it off the wall, you put it into your freezer. Goes down to about 40 degrees in 1 minute. You take it out and tell everybody, you should be feeling good because it's 40 degrees outside. They're going to call 911 and have you committed. This is the same operation that the Fed has been, the U.S. Treasury's been involved in for years, manipulating the thermometer, which artificially keeps the price of gold depressed for reasons that people know over 5,000 years of history, that gold is the truth teller of what's going on in international monetary systems. Now you say, how did they do that? Well, they do it through leverage contracts through JP Morgan and on exchanges like the COMEX exchange and the London Metal Exchange. It's very easy to put up a little bit of money, sell contracts forward, sell them in quantity enough that it just keeps the price down in the future. Then when the time comes at the end of the contract life, you buy it back, close it out. I don't want to get technical here. But the point is, through leverage, it's very easy to manipulate and keep down the price of gold. Now, what advantage did that give our trading partner over the last 10 years? They have rivers of US dollars flowing towards them because of our purchases of Chinese goods, for example. They see a price of gold that's being artificially depressed. And it's almost like somebody holding the door open when you're going in to rob a bank and wishing you good morning. How are you? Good to see you, sir. And you walk out the door with tons and tons of cheap gold floating around the world. Our keeping that price artificially depressed allowed nations around the world that were had surplus dollars to go ahead and use that to buy gold, particularly in the last couple of years or so. Well, you say, gee, there were more dollars created through trade. Well, trade expanded, right? Trade expanded dramatically with high-tech, high-value added items going out. The value of trade exploded over the last few years. Now with the volume of trade contracting, we see, gee, Frankie, there's a lot of U.S. dollars around. Look, we're filling up the room here. We allowed those other nations to accumulate gold at just giveaway prices. But now, with a new monetary system that could be unveiled in 2026, July 4th of 2026, Treasury Secretary Scott Bessent has been hinted that something big is coming, and I believe it. Because over the last year or two, we saw the cap, the artificial cap that was held over the top of gold, removed. This removal has led to a revaluation of gold at $3,000 an ounce. Now, who does that benefit? Well, it benefits a lot of people. It certainly benefits the United States because it's, if we were to take the Treasury and revalue our gold holdings, they would be about $1 trillion now. That's a lot of new, fresh liquidity. That's real purchasing power, real value. Not paper money, but real value. Let's go a step further, and this may explain why gold refuses to back off. It refuses to undergo things that look like normal corrections in price bull markets. Suppose that price of gold goes to $10,000 an ounce. Now all of a sudden, you have almost $3 trillion of liquidity, of spending ability for the United States Treasury to liquefy. Now, you may get all excited, and a lot of people around the world might get excited. Oh, wow, that's a lot of money. It is a lot of money. But it's not a lot of money when you're running $2.3, $2.5 trillion deficits per year. Do you understand what I'm saying here? You have to grasp this. The debt is compounding at such a rate that all these frantic activities are taking place now to just try to get, we have certain assets on the books of the United States government. They still have student loans as assets on the books. So no, Lord help us. But class 1, tier 1 asset in the international monetary system is gold. Tier 1, class A asset. Means there's no question about tradability. As long as it's pure, as long as it assays to be at the purity of 99.99 fine, you're good to go. Anybody will accept that. What I think ultimately they want to do is to take U.S. Treasury bonds and introduce a gold-backed bond, probably a 50-year bond. Now, 50 years is a long time, Rosie. You're going to be stinking underground. I know I am. Okay. Roosevelt, you're going to be long gone, shipped off to the netherworld. I know that. But think about this, the immediate sales that gives that. And then you kick the ball down the road 50 years and, well, everybody's gone now. That, I think that they want to have some measure of gold behind those bonds to make them saleable because they know U.S. trade is going down. We have this valley to go through of tariffs where we may or may not be rebuild manufacturing. And a lot of people say, we'll rebuild it, Rosie. Well, it takes capital. It takes money. Right now, where does most of that wealth come from? It came traditionally from the growing middle class. We have a shrinking middle class now. People are fighting to pay mortgages and paying more for groceries, and home insurance tripled over the last 5 years, and car insurance has doubled. Everybody that can stick the knife into you, stick the blood-sucking straw into you, has stuck the blood-sucking straw in. There's not the capital formation. Then it leaves just one thing, this big block of retirement asset 401ks. Well, if I might take my little needle for popping here, when DeepSeek AI came out, February from China, it popped the high-tech bubble there. Which means all of this money that was going one way now has to think about where it's going to go the other way. All of our expectations about AI are all being fulfilled in China now, not here. Big sea changes going on. But today, at least, I was able to cover a bit about the emerging framework of some emergent monetary system, of which gold figures very highly in that. It's amazing after 5,000 years, after hating gold from the 1930s on, oh, yeah, you go to your broker, oh, wow, gold, are you kidding? You want to invest in gold? Dude, you want dividends, you want growth. And here is gold, once again, the ultimate dictator of world financial affairs stepping up. You don't hear anybody poo-pooing gold. You hear, oh, wow, I wish I'd gotten in, or gee, wish I saw that coming. No, you're riding the NVIDIA plane right down into the ground here. That's where your money and your focus has been. There's a big change coming. People say silver too. Well, the price of silver has been artificially depressed too. But why? Because it's needed by the military and industry in this nation for high-tech weaponry, for solar, for other uses. There's a massive deficit of silver in the world. And through the same leveraging of contracts into forward contracts on the futures market, they've been able to successfully keep the price of silver pretty depressed. But trust and believe, over time, where gold goes, silver goes right behind. A traditional ratio of 32 to 1. You make your decision accordingly on that. That's something that can't sustain because, well, you say, well, why didn't they do the same thing with gold? Everybody piling up on gold. Because they don't make warehouses big enough, strong enough, secure enough to support and put these quantities of silver in. It's not as compact as gold is. So we've covered a lot of ground today, and as usual, I hope that you've enjoyed this insight into the potential coming of the new monetary order. May not ever come to pass, but you need to always be thinking the wildest thoughts that you can think, and then looking at guideposts along the way to see if it's true. When we had that separation between bonds and the stock market that I talked about, where traditionally stocks, if they go down, bond interest rates would go down. We broke that. I've been talking about the day that would come for 2 years and saying there will be a day that comes when stocks and things will collapse and the price of bonds, instead of going up to stimulate business, will actually move the other direction. And it came to pass. It was a wild prediction. Will it hold true? No, I'm expecting some sort of bounce back over the next couple months. A little bit of calmness before we get to craziness once again set in. But this has been, I think, a great discussion for us today, that you should always think the wildest thing. And then as pieces fall in place that confirm your thesis, you stick with that thesis, as I've done over the years, pounding the drum on gold and silver and the separation between bonds and equities. It's a heck of a world. Anyway, if you enjoyed this discussion today, please take a moment to hit the bell and subscribe and hit that bell for all notifications. You need to be aware of what's going on. If you have family and friends, you need to share these videos out so that people aren't totally blindsided by what's going to become. Nobody ever told me, well, there's a person who YouTube has done. Well, why didn't you pass it along to me? So that I could accumulate a little something out there and have a little bit. Do people a favor. Share it out. Okay? In the meantime, I'm going to bid you guys a happy Easter weekend. Thumbs up are appreciated, and your comments are welcome down below. Thanks, everybody.